A very good afternoon, everyone. I'm Florence from the Institute of Banking and Finance, and we're delighted that you're able to join us this afternoon for our IBF Masterclass jointly organized with the Singapore Consultancy, where we'll look at why Fintechs should pay attention to risk management. Here's a quick look at the agenda this afternoon. Stefan Kuhn will deliver a short welcome on behalf of Singapore Consultancy, and Stephen Xiao, Executive Director for Singapore Consultancy, will open the session with short remarks. We'll then have the afternoon keynote by Subnendu Mohanty, Chief FinTech Officer from MAS, before Deepak Sakri and Ng Feng Xiong from Singapore Consultancy will touch on the various aspects of risk management that FinTechs should pay attention to. The audience is invited to post questions to these speakers via the Q&A chat function found at your Zoom navigation bar. At any point in time, you can do this, and speakers will address these questions live at the Q&A segment. Now, before I hand the time over to Stefan to kick off the session, for those of you who may be unfamiliar with the IBF, allow me to do a very brief intro on the IBF and the resources we have to help professionals in the financial industry and fintech sector. Now, the IBF was established by the MAS in 1974 as a training provider to provide functional training for the financial industry. Since then, our role has evolved into one of standards setting for financial services sectors, skills and competencies. Since August 2018, we also expanded our mandate to cover career advisory and job matching for the financial services sector. You can say we thus adopt an integrated approach to skills development jobs for the financial services sector. Here's a quick look at our services and how we support the industry across training, recruitment, and workforce transformation. You can find out more about these services and connect with us on any of these areas via our website. As most of you may know, we have also put in place enhanced training support for the financial industry during this period to further alleviate training costs. The enhanced course fee subsidies are part of MAS's support package that was announced in April to sustain and strengthen capabilities in the single financial services and fintech sectors amid the current economic downturn. The aim of the enhanced training support is to encourage more companies to send their employees for training and upskilling so that they're in a better position to help the company move forward when economic activity normalizes. For the rest of the year, we have raised funding support for training to 95% across the board for all FTS and IBF STS programs subject to prevailing grant caps. The funding quantum will be reduced to 90% next year before going back down to pre-crisis levels in 2022. You can find out more details on the enhanced training support on our website. Apart from the increase in course fee subsidies for programs this year, training allowance of $10 per hour for self-sponsored trainees and $15 per hour for company-sponsored trainees will also be given for training undertaken this year. You can find the list of eligible training programs on the IBF Program Finder on our website. In addition to all this support, the IBF will also be supplementing the commercial training available with free webinars during this period to support the training needs of the industry. Financial professionals can also tap on the Learn at IBF mobile learning app for bite-sized learning at your own leisure. All these complimentary training are accorded with non-core CPD hours. And that concludes my short intro. I'll now hand the time over to Stefan, who will be your host for the rest of the session. Over to you, Stefan.
Thank you very much. Thank you, Florence. Good afternoon and a very warm welcome to all the participants today. It's great to have you here. This is the first time that Singapore Consultancy is doing this masterclass in partnership with IBF. And what we want to do today is we want to basically deliver a tailored program, a tailored education program to talk about risk management in fintechs. And what we want to do during the session is we want to show you the key elements that are part of risk management, and we want to show you why it's important to have your own risk management discipline. What we're going to do is we're going to show you scenarios to walk you through some of the key operational and technology risks. And obviously, we want to do that in a format that we're focusing on ongoing and emerging risks so that you have the right tools and the right understanding to basically tackle and mitigate those. Florence has kindly shared the agenda, so allow me to introduce Stephen Xiao, who is our founder and executive director. Stephen, over to you.
Hi. All right, I'm trying this. Hi. Good afternoon, everybody. Thank you, Stefan. And thank you for the kind introduction, and Florence for organizing this. We are looking forward to an exciting conversation with you on risk management for fintech firms. I'm looking at the participant list. We have like 157 people, and a couple of other people are still coming in. Very happy to have all of you. I want to take this opportunity to talk to you briefly about Singapore Consultancy. Who are we and what do we do? We started in 2016. We operate as a social enterprise. And our consultants are individuals like you're seeing today, Stefan, Peng Xiong, Deepak, Eliza, and many others. Let me just quickly do a share screen, because the best way to introduce who we are is our website. There's nothing behind the brand. There's nothing behind the company, if not for the people in the company. We have put most of our consultants on the website. We have about 60 people in Singapore, some in Hong Kong. If you click on any one of them, like Daniel, you will see 100 words bio of them. I think Daniel is here today. I just had lunch with him. You click on any one of them, like James, you will be able to see 100 word bio. Our members are senior industry practitioners coming from banks, insurance company, asset management company, the likes of MAS, GIC, and as well as fintech firms. And most of them are in the 50s and the 60s. Oldest is 75. I'm 42. And very recently, we also hired some younger ones to meet up the company. Unlike the big four firms that you typically deal with, we practice an inverted pyramid structure where you have more senior people compared to junior people. And our key proposition is experience and wisdom. Now, when you click on the company tab, you will see the history of the firm. We started in 2016. There are 3 verticals. We take senior individuals who have decades of experience in those organizations. I just talk about, convert them into consultants, put them back on projects across Asia. We also put some of them in the different sectors as board directors. Some they got it through their own connections. Some we facilitate that. We have members serving in the private sector, the public sector, and the people sector. We are very big on charities, and we serve in this area on a pro bono basis. And lastly, we also act as advisor to fintech firms. There's quite a few today on our panel, ranges from chatbot AI, data reconciliation, portfolio management, and etc. robo-advisors. If you go to our publication page, you would see the thought leadership articles that we have posted. Like Guan Yu wrote an article on DG Bank earlier, Shu Mei wrote an article that's related to customer insights. And in our last town hall, we have our oldest and our youngest, both attending the town hall virtually. So you want to know more about us, please go to our website. And if you want to be in touch, please click on here. There's a little WhatsApp icon. Click on this and you will get in touch with me directly. It's linked to my phone. Let's catch up over coffee or lunch. On the last note, I want to emphasize that Singapore Consultancy is about doing well and doing good. Fundamentally, we are a social enterprise. And if there's any way we can help you, please feel free to reach out to any of my colleagues or click on the WhatsApp icon that I mentioned earlier. Thank you. Back to you, Stefan.
Thank you, Stephen. Thank you very much. This masterclass has obviously a keynote and some presentations, but we also want to make this interactive. So you have a Q&A function at the bottom of your Zoom. So please use that to post your questions so that we have an easier time to facilitate also a discussion with you. And our keynote speaker is from MAS. Subnandu Mohanty is the Chief FinTech Officer, and he has kindly agreed to deliver today's keynote. Thank you very much for joining, Subnandu, and over to you.
Hi, Stephen. Good to see you in this role, and good afternoon, everybody. Uh, while I don't say this keynote anymore because we are all using Zoom to talk to, so it will be more of exchanging information about the topic we are going to talk today about the risk management need for fintechs. But before we go there, let me lay out some interesting uh, stats about the state of fintech in Singapore and Asia and broadly global. And if I take one number as a, or one parameter as a way to understand the impact, and it is during the COVID-19 crisis, most of the sectors are struggling, and there's a significant uh, impairment in the sectoral growth. Uh, Almost every sector you pick, anything between half to close to 90% reduction in the output from that sector. One sector which has really shined during the crisis is the fintech sector. And if I look at the numbers in Singapore itself, the last 9 months we have clocked 1.2 billion Singapore dollar of equity investment in Singapore, and that number has already exceeded last year whole year number, which is close to 1.2 billion dollar. We have 3 more months to go. Clearly, the market demand for fintech is very high. Investors have a strong faith in this space, and more so, if you look at the number below and understand where the money is going, I think that will lead to the topic we are going to talk today. And if you look at the big investment, almost 40% of the money has gone to fintechs who are in the business of helping banks to digitize. What it says that the fintech as an ecosystem has significantly moved to a collaborative mode where they're working with the banks, insurance company, financial institution, broadly speaking, and they're helping them to digitize faster. And which is as against the traditional tech which comes and work with the bank and provides a end-to-end technology, software, solution services. Fintechs have gone to the same space and being more smarter and innovative in providing a much delightful service as against traditional tech firms. And banks clearly are interested to partner with them, and which definitely creates a remarkable opportunity for fintechs to succeed. And and there are many fintechs who are not only are providing direct business to consumer services, they're also providing the same tech stack to in some country as a tech vendor. So the big story here is that the future growth of fintech will be heavily in the sector within the fintech, which is called the B2B fintech. Is the fintechs are business of providing tech infrastructure, solution infrastructure, service infrastructure in this space. So that brings to us this question that banks are highly regulated, uh, or financial institutions are highly regulated. And the regulations which the banks have to go through has got its implication on the fintech which are serving them on the back end. So there will be this tight relationship between the expectation of the banks from the fintech company to live up to the standards which they're themselves going through as the regulator expect them to provide their own services using a technology services which is trusted, which is sustainable, and follows the prescribed control and governance expectations. Now, if you look at the global market, I think largely not only Singapore, in many Asian market and also in the US, because of this growth of fintech, broadly, uh, the fintechs are suddenly under scrutiny of the regulators. There are four reasons why they have gone that way. First thing, the market growth. It is a double-digit billion-dollar market and there are some unicorns almost every 3 months. You get one unicorn coming to the market, which clearly shows that they're becoming a significant player in this space. And you would have definitely heard during last year when Google, Amazon, Facebook, Alibaba, Tencent, they were classified as big tech, and regulators started thinking about how does big tech affects the financial sector, because they're also being part of this sector, providing through e-commerce platform different financial services, and they're also competing against regulatory entities like banks, which means there is this debate going that they'll get regulated. So fintechs who are in business of providing financial services will find in many market regulations coming in, and they'll also get regulated not as a bank, but something, but for the activity they are doing, and the regulation will be proportionate to that activity. And one example, in Singapore, we had this Payment Service Act, which went this year, and we are going to regulate all the payment fintech provider, and the regulation has been broken to 7 different modular structure, so that if you are a wallet operator, or if you are a merchant acquirer, or you are a cross-border remittance agent, you will be regulated based on that particular activity you are doing, and you have to comply to the regulations. So even the B2C, which are providing financial services, are progressively getting regulated, and which means they also have to live up to the standards which regulators expect from financial institution, and so the expected thinking around risk management. Also, as in many markets, the big techs are also providing critical services that are increasingly coming under the regulatory scrutiny, and especially when there's a partnership and alliance between a bank and a tech firm and a fintech firm, because this particular partnership does create new risk for the banks, and because they're relying on firms which are new, which are small, which operate in newer technology or emerging technology like cloud. They are exposed to the cyber challenges. So there is this uneasiness among the regulatory community about, as these fintechs are getting part of this financial sector, how to ensure that it doesn't create more risk than what we have today, and ensure that the fintech partnering into the space are also understanding the principles of risk management they must also adhere to, so they can fit into this regulated space. Broadly speaking, I think from a fintech standpoint, it's a good thing. And many a time I have heard many investors are actually more interested to fund a fintech if they find that particular fintech is regulated. In a way, they're signaling that if you are regulated, you are implicitly complying to the regulatory standard, and you have a strong risk management framework operating within your firm. When you talk about risk management framework, broadly in my mind is operational. There's a financial risk management, there's a regulatory risk management, and a reputational risk management. And many a times, small fintech firms, because of strange reasons, they get, especially on the reputational side, some investor get caught in some bad news, and the firm goes through a challenge in this market. So you have to watch out that space quite closely, because as investors, as new people with money going to come and invest in the sector, fintech firms have to start thinking very carefully whom they're getting money from, what kind of people they're employing in their own firm, what kind of governance structure they're having within their own setup, how operationally they're resilient, so that the company is able to sustain different crises. So that's the big broad, and I'm not intending to go deeper into each of those the pillars. I'm sure there are many people who can help all of you, but from a strategy perspective, a fintech is best served if they have thought through all this 4 aspects of risk management. And again, as we all know, that it all starts from the top. And given the fintech firms are young, they are it's normally the founders are from the industry, mostly from the financial sector. They would understand the value of risk management. They'll understand the value of understanding the regulatory requirement. And that's the reason why I believe that tone should start from the top. And we expect the founders and the senior leadership of the fintech should carefully consider their own internal risk management framework. And again, it should not be patchy work. It should be completely end-to-end. The clear perspective has to be developed not only from their own firm, but also beyond that, in terms of how they plug into a third-party systems, how they work with the banks, how they work if they're providing financial services themselves, how they're ensuring that the products are complying to the regulatory expectation. Of course, there are certain incentives which is going to be around, so that they do practice the right robust risk management. Because one incentive I can think that if you're doing a great, if you're managing a firm from a risk perspective well, definitely you will able to raise more money as you're growing your firm, because investors at a later stage are definitely going to expect a stable and a well-governed fintech company, because towards the later part of your fundraising process, you are getting into big investor with big money. It is okay at the initial stage when you are getting a seed money, the expectation and the pressure for such thing may not be that big. But once you get bigger and you look for raising more money, there's a clear incentive for you to get right risk management structures in your firm. Again, you got to also think it should be baked in your product by design. Fintech companies are very smart a bunch of smart people who have designed products based on remarkable consumer experiences requirement. They must also think about, by design, these products are robust in terms of operations, in terms of security, in terms of cyber security design, in terms of where they operate from cloud. They have gone through the whole process of control, IT controls within that framework of operating that product. And lastly, I strongly believe there has to be strong sense of accountability. You cannot get away by saying you're a startup, you're a small company, so you don't have obligation to do risk management. No, I think that's a non-negotiable. If you're working with the financial sector, you're expected to have a strong risk management understanding. You're expected to build the right processes, and your product should have the right resiliency as you get plugged into the system. So there is no escape on accountability, and the accountability clearly lies with the founder. The accountability clearly lies with the CEO or the leadership of the fintech firm. So you cannot get away from that thinking you're a small startup and you may not have the resources to do it. It is okay when you're experimenting. It's okay when you're doing a pilot or a POC, but not when you're doing a production system. And as a response to that, during the COVID-19, almost at the starting of the COVID-19, MAS created a support system, or funded a program with the Singapore FinTech Association, where we put together a framework for fintechs to self-assess themselves under a FSP compliance readiness framework. And this whole framework was based on the current OSPAR and the TRM requirement and the MAS cyber hygiene notice. You ask any of consulting firm who do this work, they'll be well versed in these principles of the compliance readiness framework. I think they can help you to figure out, are you complying to those expectations? But again, in that whole framework, I think the big part is, in my mind, apart from the broad ensuring you have the right control environment, you do the right risk assessment, you build the right information and communication strategy, you have the right monitoring in place, and also you are also ensuring your own subcontractors are also complying to the same requirement which you are going to deliver to your client. And within the broader technology controls, the usual suspect, you should have the right logical security, the right physical security, change management, incident management, backup security, recovery, network management. So the whole stack of controls are expected from you as you get through this framework. But there's one little disappointment I have, and I'm going to use this platform to talk about it. This whole program was running for almost 3 to 4 months. I was asking Hoklai, the Singapore FinTech Association president, how many companies have gone through the framework. The number he reported today morning was something around 62 or 65. We have 800 fintech company. If only 62 or 60 or 65 company have at least chosen to get themselves certified under the risk management framework, which has been put together by the Singapore FinTech Association, clearly shows we have a huge gap. We have 800 fintech companies. Only 60 have thought that it is important for them to get themselves checked out within this framework. So it clearly shows the market has not understood the importance of having the right risk management framework and the importance of getting themselves acquainted with the regulatory expectation. So if this is the trend, I think the challenges, the road ahead will be much more difficult, because more and more regulators are going to scrutinize these fintech firms very closely, from cybersecurity, from AML, KYC, even the own corporate governance. So there's a whole set of things they will look at as this market grow. But we are not a small market anymore. We are $1.2 billion coming here as an investment. Definitely as a market, we are growing. So I will strongly encourage all of you to go and get yourself checked out within this framework and get yourself certified, because that is critical for our success. And Singapore's fintech ecosystem is growing every year. We're growing at almost double the pace in terms of number, in terms of value. And we are in the cusp of growing further, because we have 5 more digital licenses going to be dispensed by end of the year, sometime early part of the year, which means more fintech firms are going to work with this new digital bank license as a tech service provider, which means this expectation is going to grow bigger, stronger, and you must get ready for it. And if you are not ready for it, I think there's a high chance that you may have an existential crisis within this environment, because fintech will be part of the regulatory scrutiny, and there's no way you can escape that. But with a positive note, risk management is good. It helps you to become a robust company. It helps you to be more resilient to crisis, to challenges, and there's no reason why you should not do as a part of your natural growth and part of your maturity process. So with that, I'm going to end my key address, and I'm ready to take some questions if there are some out there.
Perfect. Thank you very much, Saminanda. That was very, very good. And set the stage. We have a first question in the Q&A module already. I encourage all the other participants, if you have a question, you have the Chief FinTech Officer here to help give you some guidance or some outlooks. And the first question that I have in the Q&A is related to regulation that Hong Kong SFC put out there. And that was twofold. It was around WhatsApp, it was about instant messaging, and one requirement is record keeping. So SFC in this year has reiterated that it's necessary that these new media belong to the record keeping universe, so you have to keep it for 2 years. And the other one was in 2018, SFC basically mandated that all that the chats have to be used for surveillance. Can you maybe answer how MAS looks at that? And
I presume this question is not generally for fintechs. I think this question is generally for, is this set of communication as part of your record keeping expectation, right? Is that how I should read the question?
Yes, that's correct.
Yes. So I think this is definitely part of the, well, I don't have a specific pointer to that, but I'll presume that this should be part of the general record keeping of if that's being part of the interaction, whether it's for a sales process or for any discussion in the financial transaction.
Yeah, so I guess it's common sense that record keeping extends to yes, any way of documents. And again, SFC has spelled that out particularly and has put a paper in place so that no one forgets. But I guess in Singapore we also can rely on common sense.
Because I know in the market side, in the market regulation, this kind of information are regularly monitored for market manipulation, so this is part of the data a lot of regulators use to monitor any market activities which may not be appropriate.
Perfect, thank you, Sapnando. So we have a second question here, and that is around the risk management certification that is recognized by MAS, and there's a couple of different aspects. So maybe John, you can clarify the question. So one of the projects that MAS supported was to speed up the engagement between financial institutions and fintechs, right? Yes. So when you engage with over to you, sorry.
No. I think you're right. I think the question is that we put together, we supported a broad compliance readiness framework. I will strongly encourage, go to the Singapore FinTech Association website. There is a if you go to the website, you can check it out. There's a readiness framework, and the Singapore FinTech Association is supporting certifying the fintechs under that framework, which is actually based on MAS guidelines for what you call as outsourcing service provider audit report, the TRM tech risk management guidelines, and the cyber hygiene notice requirement. So all the underlying MAS expectation are baked into that compliance readiness framework. I strongly encourage all to go and get yourself checked out in that particular framework readiness, which is out there in that website, their website.
Yeah. To give some more background for the participants, this framework was put out there to speed up the due diligence process. So if you as a fintech want to engage with a financial institutions have to do a lot of due diligence checks before they can engage with you. And what this program does, it basically goes through the key requirements and makes sure that you are in a good spot. And you can partner with external firms to speed up that process. So if you go to SFA, you see the partners that are available to help you. Besides that, I think this framework is also good if you just want to look at your own risk management. So the framework is helping you to go through the key points, whether or not you need a license for yourself, PSA or capital market service, or you want to engage with a regulated entity. That program is basically the one-on-one that should be there. And again, Subnandu pointed out, when you want to engage later on in your financing rounds, having that in place is not optional, that's mandatory.
And again, this rightly Stefan pointed out, once you find certain gap, you are expected to join, talk to one of the firms out there who can help you to put the right corrective action in place to strengthen that particular gap. I think there's a second question. I want to take it also, if Stefan, if you don't mind. Sure. I think, yes, that question is very valid. We also debated in our head that how to expect a one-year-old fintech to immediately get certified within this framework. Yes, I think it all depends on what you do. If you are a early fintech firm and you are providing a particular tech services to an institution, I think the banks would expect you to comply to that process anyway. And if you're doing an early experiment, if you're doing a pilot, there are certain leeway out there. But I think once you are up there and providing a service based on bank's own assessment of that particular service, you have to comply to the TRM guidelines and the outsourcing guidelines. I think I would, before we even prejudge that the compliance readiness is actually stringent, I would strongly encourage to check it out. I personally believe most of the compliance readiness framework we have is actually suitable to even a very early stage company. It is not an overarching or onerous process. I think the fear of unknown is quite high. I strongly encourage for you, all of you, to go and check it out. In case you have a specific area where you think that it is a highly onerous process, I strongly encourage for you to write to MAS, and we can actually start having a discussion in that particular, if there are things to look at. But please, before you prejudge that, please go and check it out. You may find it not that stringent as you think.
Perfect, thank you. We have time for one or two more questions, so feel free to post your question in the Q&A segment. It's one of the opportunities to engage with MAS directly.
I think I would presume the big question was the last question. I think that the fintechs have this fear of being overburdened with the regulatory expectation, but I think that's a valid concern, and we have thought to that, and that's, if you look at the framework which I'm talking about, referring to, check it out. It should not be that challenging. However, I must re-emphasize on this. It is anyway good for the firm. It's anyway, if you are going to raise money, if you're going to build a system which you believe are going to process millions of transactions, that has to be part of your thinking. You can't avoid that. We cannot be in a situation where a particular critical service provider gets into a serious risk management gap.
Yeah. And I think I can attest to that as well. I was part in the consultation process in 2019. MAS is listening, and MAS wants the dialogue, and there's no approach of like putting regulation out there and just leaving people hang out to dry. This is really a very interactive process.
So there's
a technical question on the fintech penetration. I'm not sure whether we have that data available. G7 versus G20 countries. I don't know whether that's measured by GDP or by number. That's
Okay.
a very broad
maybe,
question.
Maybe I can help I think that question needs some clarification. When people say fintech, sometimes it means payment or a lending system or a lending platform, and in many cases that's the definition. But when we say fintech in Singapore, there are two kind of fintech. There are fintechs who provide a certain financial services. Mostly it is a payment services or robot advisory or a lending or a unsecured lending services or a platform lending. And there are quite dominant fintech who are in the business of digitizing SMEs, digitizing banks, digitizing insurance companies, so that they provide the tech stack so that they can automate the financial services. I think the compliance readiness framework predominantly applies to that set of companies who are collaborating with the bank, and bank being regulated is expected to drive that regulatory expectation from the firms. But the fintechs who are providing financial services, our existing regulatory framework are going to anyway govern them. So if the question is that broad, I don't think we have data right now, but I can say that purely on the payment side, we have quite a significant penetration of fintech in this market in terms of moving the digital money. In terms of lending, it's quite a very small, because we are highly banked country in Singapore, and our banks do serve most of the financial services requirement. There are certain segment, especially in the SME funding and payment processing, which is done by fintechs in Singapore, unlike other emerging market where there's a dominant play.
Okay, I have one more question. If that person can just answer yes or no, whether this is pertaining to account opening, feel free to just give that additional information. So the question was whether MAS is able to assist with approvals for bank applications. So I guess a bank application is here, account opening, and maybe the word crypto should be here as well.
Yes, I do understand the question. I think, well, I would not deny that if you're a crypto firm, you do struggle to get a bank account open because the process which banks have to validate you before they open an account is quite stringent in that process, in that sense. And I have heard about this. But one thing I can suggest that the Crypto Association has come together to put together I think this year only with a framework on how to get that thing sorted out. But I think progressively it's getting better. It used to be challenging earlier. Sorry, he has clarified. Oh, you're in the payment industry. You should not have any problem. You should not have any problem. If you have a specific problem, please reach out to me. My address is swapnendu_mohanty@mas.gov.sg. If you are in that payment industry, I see no reason why you have a challenge unless they have a specific reason.
Okay, that might be a very, very broad area to get into. So yeah, feel free to take up that offer. So then thank you very much for your time. I think it's great that you supported this masterclass in this format. And I think it's a good way to break down.
I don't know the masterclass, but all I can say that I stand behind this purpose of this conference, that we can't escape risk management. For fintech must get there, get it right, get it correct. And I think more so, if you're growing and we're getting matured, this is a sector. This is a part of the corporate strengthening. We got to get our act together strongly.
Perfect. Thank you very much for being our keynote speaker today. Thank you very much, Nando.
Thank you for having me.
So you have tried this Q&A module, so please feel free. We have now 2 speakers who are our experts in risk management in Singapore Consultancy, and this will take a little bit longer. So whenever you have a question, please post them. I will get back to them after this session so that we can then go through them. We have sufficient time at the end for Q&A, but for now, let me hand over to Peng Xiong and Deepak to walk us through some of the scenarios and the elements of risk management. Over to you, Deepak.
Thank you, Stefan, and good afternoon to all of you. Thanks for your presence at this webinar that we're running right now. I'd intended to start by talking about why risk management is important, but actually from this graphic, you'll see that Swapnendu has already very well articulated why risk management is important. This is just, kind of like a visualization. So I won't spend too much time on this slide other than to say that, Swapnendu has highlighted that there are compliance reasons why risk management is important for you, but there are also reasons that work to your advantage. One of which Swapnendu mentioned was the funding for fintechs becoming more likely if you are in a regulated entity and you undertake, if you therefore you do undertake risk management. The other one is that we strongly believe that if you have a good risk management discipline, it places you at an advantage when you deal with your prospective customers, being the banks, because you know that what controls generally banks would require. You can approach them confidently when you engage with them. Let me move on then to the next item here, which is, we touched on risk management. Now, what is risk management? What are the kinds of risks that an organization may encounter? Now, this is what I call the risk universe. You see 7 categories of risk types over here. Not all risk types are applicable to all organizations, but some of these are quite fundamental to most, if not all, especially if you're in the fintech sector or if you're in the financial services industry. Technology and operational are 2 key ones. Of course, banks will also be subject to a number of others that you'll see over here, like market risk and credit risk. I'll just give some quick examples of what some of these are. If you look at market risk, for example, I think this is one that played out quite significantly when the pandemic happened. You saw a massive disruption of the supply chain. And this may very well have impacted yourself as a fintech, or as a bank. Supply chain disruption is definitely one of the market risks that you need to be aware of. I'll then just touch on operational risks. So now operational risks generally relate to human error or fraud. Having said that, operational risks are not limited only to the operation space. Within technology, there is a function called IT operations. There's a lot of activity going on in that space. IT administration, for example, database administration. There could be operational errors there as well. The third one I just want to mention, we'll be talking much more about these 2 areas in the rest of this presentation. We have about an hour or so set aside to discuss operational and technology risks. But briefly, technology risks include things like security breaches, operational errors, even things that go wrong in software development process or project management. So those are things we classify as technology risks. Important thing over here is to figure out what are the ones that are applicable to your area, because if you do and you take action to address them, you'll be in a much better place. I'm going to touch on now the risk management life cycle. So, we talked about risk management. Now, what is it and what would one need to do in order to implement risk management in an organization? What are the key principles around them? 4 stages over here in the risk management life cycle. I'll just go through each one of them, briefly touch on the more important elements. The first one here is identification. Swapnendu mentioned that the accountability for risk management starts at the very top of the organization, right? So that's the tone from the top. Essential that, as part of that, the fundamentals for risk management get introduced, things like risk management processes, getting people with the right skill sets in order to be able to do effective risk management, or if you do not have, then engage consultancy firms or other firms that can support you in that initiative. And also tools, because you do want to maintain a register of your risks and ensure that you are reviewing them on a regular basis. Secondly, here is to determine risk appetite. Now, what I mean by risk appetite, if I can give an example of, if I can create an analogy for what risk appetite is. Now, when you're driving on the expressway, you know that you have to keep to a speed limit of 80 kilometers or 90 kilometers, depending on which section of the expressway you're on. And the speedometer tells you where you are with respect to that threshold at any given point in time. So that actually is like the risk appetite for your organization. You need to know what your thresholds are for risk in your organization, below which, if you have identified a risk and that the risk falls within the risk appetite, you could consider that to be something that you accept and probably do not have to do anything about it. Because if that risk materializes, you know that you have established your appetite and it's within that appetite. Where it becomes, where risk appetite then comes into play also is when you have identified a risk, done the assessment, and determined that it falls outside of the risk appetite. That is what we consider unacceptable risk. And here is where you have to take action in order to make unacceptable risk then move into the acceptable risk zone, as you see on this chart over here. Risk appetite is something that takes time to work on. You might peg it to, for example, tolerance of how much of sales or revenue you can forgo if a risk is to materialize. So that's an example of how you could determine risk appetite. Alignment to regulatory requirements also could be considered to be a way to determine risk appetite. What I've observed is that you probably will need a number of statements in order to articulate your risk appetite. One statement is not going to encapsulate everything because there's a variety of different types of risk that are out there. Now, once you've determined your risk appetite, then you can start looking at your risk scenarios. And here really is, looking at what the threats are to your organization if something goes wrong, and formulate what would be the risk if something goes wrong. Now, we talk about risk scenarios over here as opposed to risk. And the main difference between a risk scenario and a risk is that a scenario is more precise explanation of a risk. If you look at this example over here, the first example here, now application failure, we know it's a risk, right? An application fails, something goes wrong, there's consequential impact to customers, users within the organization, so on. However, not all application failures are going to be detrimental for an organization. The ones that are detrimental are likely to be the ones that fall outside your risk appetite, and there's something that you'll need to do about it. So for example, if you clarify this application failure as failure of critical infrastructure application for more than X number of hours, X being a tolerance limit, this then becomes a basis for you to, as you move through the life cycle, to be able to do the assessment and determine what response you require in order to address the risk. So, all risk scenario it's a more precise way to define a risk. Now, there are various ways that you can go about determining your risk scenarios, either looking at the business objectives or top-down, or looking at generic scenarios and then building them upwards. But one good gauge is to ask yourself the question, ask your colleagues the question as well, what keeps you awake at night? Because if there is something that is lingering in your mind, it is possible that that could be a risk that you will need to then flesh out into a scenario and take it through the risk management life cycle further down. Clearly, you have to establish accountabilities and responsibilities. As Swapnendu mentioned, accountability clearly sits with, at the top of the organization, the CEO, the executive management, or the board. In addition to that, we see that everyone has a responsibility to play a role in managing risks, whether the individual is a programmer or a subject matter expert or someone in operations. Everyone in the organization has to be responsible for risk management to different degrees. And that's where it's important for you to promote risk awareness within your organization so that everyone knows that they have a role to play in risk management. Moving on to the next stage of the life cycle, which is assessment. So now you have already established your risk scenarios. What do you do with those risk scenarios? Obviously, the first thing you want to do is to do an analysis of the risk scenarios. And typically, when we do analysis of risk scenarios, we look at two dimensions. The first dimension being what is the likelihood of that risk materializing? And there's this this measurement here, which you can consider. The other dimension is if that risk materializes, what's the impact to your organization? And here, we've just used in this sample from negligible to severe. Now, once you have a matrix like this, it's easy for you if you now then overlay your risk appetite to determine which are the types of risks where the risk magnitude is acceptable to you, and which are the risks where the risk is not acceptable to you, right? So you use a matrix like this in order to determine and rate risks and determine the magnitude. I'll give you an example of a scenario and what might be the magnitude of the risk for this this matrix over here. A loss of electrical supply to office environment for more than 30 minutes. So you set a limit of 30 minutes because you see that per your risk appetite, beyond that, you're going to be suffering an impact that makes it fall into unacceptable risk. So it could be that this risk could occur, it's possible. And if it does materialize, it's going to be of moderate impact. And you can see here that it falls within, this, oops, excuse me. You can see that it falls here within the unacceptable risk zone. Another example of a risk that you may have identified a risk scenario is an unavailability of key resources, be it people or tools, for example, for system development for one working day. So these are people who are working on projects, right? And you may see that in this case, it's unlikely to occur because you have catered for adequate backups. And if it does happen, then the risk could be considered minor. And if you see then, if you look at the intersection over here, this falls within acceptable risk. So this is potentially something that you can tolerate without having to do anything about it. So that's how you correlate risk appetite with risk rating on a matrix like this. Now, impact, Swapnendu touched on this as well. There are 4 key categories we normally consider when we try to do the impact analysis for risk, be it financial operations, regulatory, or reputation. And each one of these can have some grading on the impact side of this matrix over here. Right, so you have done the risk assessment. You have put them on that risk matrix chart. You're able to see which are the risks that you think you need to act upon because they're unacceptable risks. For those you want to understand where you are today with the risk, and then what you need, where you need to be in order for that risk to become something that is acceptable, right? So, do a gap analysis. And last but not least, very important, assign risk ownership. Every risk scenario, once it's assessed and deemed to be something that needs to be attended to, has to have a risk owner. Otherwise, there's a high likelihood that, that risk will not be addressed. And if it materializes, it can have detrimental impact to your organization. Moving on to the next stage of the life cycle, which is response and mitigation. So here we are now. You have already analyzed your risks. You have determined what are the ones that need attention. So what you do here is develop your risk response. Now, the objective of developing risk response is to take a risk that was in the amber zone over here, unacceptable risk, and move it to the left, right? So either reduce the impact so that it falls within the acceptable zone, or reduce the likelihood so that it falls within the acceptable risk zone. And it's very possible that you could be addressing a risk such that it actually reduces both the impact and the likelihood. And if a risk has been completely addressed, it no longer then is something that you need to consider. But that doesn't mean that you don't have to review it on a regular basis. When we talk about formulating responses to risk, basically that's like determining what you want to do. There are 4 ways to actually respond to a risk: mitigate, avoid, transfer, or accept. Mitigation is basically taking something from here in, and implementing controls so that it becomes an acceptable risk. So you are not eliminating the risk altogether, but with the controls that you implement, you actually reduce the magnitude of the risk to an acceptable level. Things like, monitoring activity of privileged accounts. You will all have privileged accounts that you use for administration purposes. You want to be able to monitor what is happening when a privileged account is being used. So that's a mitigation control. In the software development space, testing is actually mitigation for the development process to ensure that any defects that are identified get addressed before they move into production. Avoiding a risk is to say that you want to exit from the activities or conditions that give rise to the risk. So, for instance, the example that we used earlier on, which was regarding the loss of electrical supply to the office for more than 30 minutes, which placed the risk over here in the unacceptable space. Now, if you are able to obtain an independent separate source of power supply, so you have dual power supply such that if one goes down, the other one is likely to be still available, that actually is a form of that's a form of mitigating a risk. An example of avoiding that same risk would be if you had an alternate location and you move the people from the location that's been impacted by the power failure to the alternate location. So that's an example of avoiding the risk because you have relocated people to a safer location. Transfer risk is where you are actually, for example, taking on insurance to mitigate the financial impacts of the risk materializing. So many insurance firms today are offering cybersecurity insurance. And when you do take out insurance, that's a form of transferring risk, but only the financial aspects. Should a cyber security risk materializes, you'll still need to deal with the regulatory reputation implications of that risk materializing. Engaging a third party is also considered a transfer of risk. Now, if you deem that none of these 3 responses could be fulfilled, you couldn't address a risk using any of these 3 responses, you then have no choice but to accept the risk. If it is something that you feel that, if it's an activity, if it's a risk based on an activity that you must undertake, and you can't address it by one of these three, you have to accept the risk. However, there's some considerations over here when you accept the risk. Ensure that there's adequate governance over the acceptance of the risk. And it's also important to review accepted risks regularly, because things change over time, and something that might have deemed to be a risk at this point in time may have actually escalated in severity over time. Do bear in mind though that when you accept a risk, if it materializes, you have to bear with the consequences of the risk that has materialized. So once you have determined what your risk responses are, and again here, for a given risk that you decide that you want to take action, you may actually have more than one response. So then the onus falls on you to choose what's the best response based on various factors, whether it's cost or effectiveness of time, so on and so forth. You then, once you've decided what you want to do, you develop and execute the action plans, and then you go about implementing, you may need to go about implementing mitigating controls for the duration of time that the execution of the action plan is going on. Right, so that's stage number 3, and then we move to stage 4, which is now you have risks that have been addressed. It doesn't stop there. You have to keep monitoring your risk portfolio, your risk register on an ongoing basis. One way to go about doing this is to establish KRIs and KPIs, key risk indicators and key performance indicators. So a key risk indicator is a measure on what you have deemed to be a key risk for your organization. A key performance indicator is a measure of effectiveness of a process. Now, oftentimes, these two will be used independently of one another. The audience here is different. KRI is typically focusing more on risk management. So a risk management audience will be more interested in KRIs, whereas KPIs deal more with processes. And therefore, the process owners, for example, would be more interested in KPIs. But we do see occasions where the two of them, both of them working in tandem, make things much more effective. Now, let's just take an example over here of this cyber hygiene requirement number 2, right? So this is in the cyber hygiene notice, which is enforceable, an enforceable set of requirements. The requirement number 2 says that security patches have to be implemented within a time frame, right? So this is something you must do. You cannot run away from. What you do is you go about, defining your patching process, and then determining what are the indicators that you want to use in that process. So, for example, you establish that you want to make sure that critical security patches are implemented at most within 30 days or less, right? So that's basically your KPI for that process for critical patches. You establish the KPI 30 days. Now, given that this is an enforceable requirement, it does make sense also to incorporate a KRI that is slightly below the 30-day threshold, such that if the KRI is breached, it becomes an alert to take action before the 30-day process indicator is breached, because that is when this becomes a non-compliance. So in this example over here, you're measuring the performance of database patching. The KPI, as we had mentioned, is 30 days for critical patches. You decide that you want to also introduce a KRI of 25 days and monitor the progress of patching on a month-by-month basis. So as you can see over here, database 1, the blue line, and database 3, the gray line, are well within thresholds of both the KPI as well as the KRI. But you can observe that the performance, the patching duration of database 2 is deteriorating. It's getting worse over time, right? To the point that, in September, it actually breached the 25-day mark, this would actually raise a trigger to get attention to address the reasons why the indicator has been breached before it has a chance to breach the performance indicator and become a non-compliance. Perform review control assessments, touched on just now, Supnindu touched on just now about regarding the compliance readiness framework from SFA. That's a set of requirements for controls that you should implement. Perform review, control assessments. Review that list on a regular basis. Doing it just once is not good enough because it gives you, when you do an assessment once, it gives you a point in time result. We know that things change over time, and therefore there's a need to perform and review control assessments on a regular basis. Last but not least is to keep a lookout for changes or trends that may impact your environment. So, things are very dynamic. There's ever evolving, risks are ever evolving, new risks are emerging. And therefore it's important for you to be abreast of what's going on and to analyze whether, something that has changed, for example, a new regulatory requirement has been introduced. What implications does that have on your risk portfolio? Is that something that you need to attend to? Right? So keep, be on the lookout for changes and trends. So these are the 4 steps, key principles for each step, stage rather in the life cycle. Now, before I move on to the next part that we're going to devote the rest of this webinar to, which is on examples of risks, I just wanted to share with you this one slide over here. This was taken from the UK-based regulatory authority, the Financial Conduct Authority, or FCA as they're called. They did this survey with about 300 of their members, financial institutions and so on cyber and technology resilience. Right. So these were the key themes. So basically, one of the questions they asked was to provide root causes for incidents that happened within these organizations. Now, an incident is basically, an effect of an issue or a risk materializing, right? So this is basically showing the effects. If you know the effects, you can work backwards, identify what are the risks that are likely to have caused, the situation to the incident to happen, and therefore you could take, corrective measures to address those risks, be it risks that you have already been aware of, or be they unknown risks. So the trends over here, there are various root causes of incidents. The top 4 here being change management, third-party failure, software application issue, cyber attack, right? So you can see that, a large chunk of these, or at least 70% of the 400 odd responses they received for root cause, relate to these 4 areas over here. And this actually is going to be more or less the focus of the remainder of our session. We're going to touch on cybersecurity risks, IT operations, as well as software development. So collectively, within these 3, we'll be showing examples of those 4 root cause areas that I showed you on the earlier slide. So with that, I'll actually hand off to Peng Xiong, who is going to take you on an understanding of cybersecurity risks.
All right, Deepak, thank you very much. Hi, everybody. My name is Peng Xiong. And over the next few slides, I'll be talking to you about cybersecurity. So on the slide that you see on the screen, the triangle to the left, right? So that is known as the CIA triad. So CIA stands for confidentiality, integrity, and availability. And in cybersecurity, the risks, vulnerabilities, and threats, they all relate to one or more areas of CIA. The rest of the slide, the stuff on the right, it's a bit busy, right? So these are examples of control frameworks, libraries, and checklists I have chosen them to show their breadth and depth of coverage. Right? So for example, the top in the middle, CIS controls, it is divided into 3 broad categories and 20 domains. And then the MAS Technology Risk Management Guidelines that we are all very familiar with, that one has 12 broad categories and 6 appendices. Whereas some of the other examples on the slide here, so for example, the top right, SANS DevSecOps, right? So cloud security and DevSecOps best practices. Also the one further down below CIS controls OWASP API security project. And then finally, the flow chart looking picture at the bottom, that is for the CVSS security vulnerability scanning. So these are all very focused, right? So you have very broad ones, and then you have very deep ones. So moving on to the next slide. This slide is from the Singapore Cybersecurity Landscape 2019. It's published by the Singapore Cybersecurity Agency. I'm not going to go through any of those, just to highlight the call out that the, for example, phishing, website defacement, and ransomware. And then moving on to the next slide. So over here, I've chosen some examples of actual cybersecurity incidents that are reported in the news. Right, so I've chosen them based on the bad outcomes that happen, such as data being exposed, money being lost, services disrupted, and also the different means by which these bad outcomes happen. So over the next few slides, I will go through each of these cases in slightly more detail. Okay, so over here now, this is the SingHealth breach that I think by now everybody in Singapore, most of us would have heard about it. Right, so there was a government level commission of inquiry, and then the COI report is available on government website. You can download it and read it yourself. So some of the key known facts for this incident is that the intrusion began in about August 2017. It was detected in July 2018, so about 11 months. And in that time, the intruder did what is known as a lateral movement. So first they broke into a low value system, and then progressively, they moved to higher and higher value systems until eventually they got to the what are known as the crown jewels of the environment. And as a result, the personal data of 1.5 million patients were exfiltrated, as well as some medical data of about 160,000 patients. Okay, and in terms of impact, then all 3 of CIA were impacted. Now we'll move on to the next slide. So this one is a recent case, right? A Chilean bank, Banco Estado, it shut down all its branches due to a ransomware attack. So under the box known facts, you see that I have put a question mark there because actually beyond the headline itself, not much is known about this particular attack. Indeed, when I was putting together this presentation, these slides together, so I read up about quite a number of ransomware incidents, and most of them, other than the headlines, there's not much details that are publicized. However, of course, after you look at enough of them, then some kind of a big picture will emerge. So ransomware attacks is a rising trend, right? Frequency and sophistication are increasing. And the bad outcomes could be that if an organization has been inflicted with ransomware, then your data could be locked by encryption, right? So the bad guys have encrypted your data. And then because your applications don't have the key to decrypt the data, then your services are disrupted and you have lost access to your data. And your data could be exfiltrated, right? And then it could also be released on what is known as the dark web, the online black markets. So it could be that, for example, a victim organization does not want to pay a ransom, so the bad guys would release the data, they sell it on the dark web. Or it's also possible, there were cases where a organization pays a ransom, however, the bad guys still sold the data anyway, right? So they make money both ways, right? They collected the ransom and they sold the data. And nowadays, there is what is known as ransomware as a service. So initially, the cyber gangs that perform ransomware attacks needed certain level of sophistication. However, nowadays, it is possible to outsource. So this has reduced the barrier to entry of big guys doing ransomware attacks. Moving on to the next slide. This one is about KuCoin. It's a cryptocurrency exchange based in Singapore. right? So around the end of September last month, the known facts are that the KuCoin's hot crypto wallets had their private keys compromised. And as a result, about $150 million worth of crypto money were transferred out according to the various cryptocurrencies protocols. So what are hot crypto wallets? So these are actually the servers running applications that enable trading of cryptocurrency. So they're called hot wallets in comparison and contrast with what are known as cold wallets, right? So these are more like hardware security modules. They're usually kept offline, so they're more secure. So in this case here, KuCoin had their hot crypto wallets compromised. And of course, services were disrupted while they shut down to figure out what's going on. So the latest information as of early this month is that about $200 million worth of crypto money has been recovered. So, okay, they thought they lost 150 million, but they have by now recovered about 200 million. So it sounds like they made money. Not really. It just means that initially the amount of money that they thought they lost was an underestimation. Okay, right now at this point, allow me to do a slight digression to talk about blockchain and crypto money. Right, so one of the often touted benefits of this crypto money is that they are decentralized. So they are not subject to centralized controls. They are resistant to what is called government censorship. All right, so but in this case here, this particular cryptocurrency exchange, after being hacked, has managed to work with some of the blockchain operators to reverse the transactions that transfer the money out to them. So of course, this being a case of theft, right? So we often, yeah, that's a good thing. But just bear in mind that this actually kinds of calls into challenge the claim that blockchains could be decentralized, resistant to centralized controls, and so on. So there's something to think about for all those fintechs that are doing blockchain and crypto money. Okay, now we move on to the next slide. Yeah, this is a fintech called Dave. They reported a data breach involving about 7.5 million of their users. So how did they find out? They were told, right, that their data, so it's customer PII, that's personally identifiable information consisting of names, physical address, email address, telephone numbers, and so on, right, as well as hash passwords. They were available for sale on the dark web black market. Right, and then Dave eventually reported that the breach happened through a third party, the other party called WayDev. WayDev themselves, they did subsequently then release information about the breach. And from there, what we know is that the initial attack was an SQL injection against WayDev's web application. And then from there, once the application was compromised, the intruder then did further attacks and stole the GitHub and GitLab security credentials belonging to WayDev. And then using those credentials, further attacks were carried out with the end result that Dave's data was compromised. So what is not known but worth thinking about would be that firstly, GitHub and GitLab, these are source code repositories, right, in the cloud. So normally you use them to store source code, documentation. Usually they're not used to store data, right? People shouldn't be storing data there for data use databases. So the question is, so how did compromised source code repositories lead to the compromise of data that are presumably stored in databases? And then next question would be, so how was this compromised data exfiltrated? So these are not known, but something to worth thinking about. Next case. This one is about Amazon S3. So Amazon S3 is a cloud-based storage service by Amazon Web Services, right? So a bucket is like what we call a folder in Windows Explorer. So here in this case, a misconfigured Amazon S3 bucket exposed the customer data belonging to Dow Jones. So the known facts are that the Dow Jones was informed by a third party on the 30th of May, 2017. And then the access was closed on the 6th of June. That's about a week after that. All right, so the S3 bucket was configured for semi-public access. So what it means is that pretty much just anybody who knew the URL to the bucket could retrieve the information that is stored there. So the firm said that the data that was exposed comprises of PII and financial data about 2 million. The third party that actually found the open bucket, in this case, it was a cybersecurity consulting firm, right? They claim that it's closer to 4 million customers. right? The data belonging to closer to 4 million customers. And then there was also other private and confidential data that was exposed. Again, what is not known but worth thinking about would be that for how long has the bucket been open, and who else, right? How many other people, how many other organizations, teams, bad guys found out about the open bucket, but did not tell Dow Jones in this case. And if you look at the headline, it says yet another misconfigured. So this is just one in a series of many misconfigured, be it the S3 buckets or Azure storage or Google storage, right? Happens all the time. Okay, moving on to the next case, and I think this would be our last one. So Scotiabank, they had exposed their source code and credentials on GitHub repositories. All right, so GitHub, earlier, as I mentioned, it is a source code repository. It allows the possibility of public repositories as well as private repositories. Right, so that in this case, it looks like Scotiabank's private repository was exposed. And then in the repository was found hundreds of files of code and documentation, as well as access credentials to backend systems. Now, normally you ought not to check in your access credentials into your source code repositories, right? That's a bad practice. So in this case, the bank was informed by a third party in September 2019. The access was closed in 24 hours. But again, same questions, right? So who else found out, knew about the open repository, downloaded stuff, and did not tell, and for how long was that the case? So we've looked at moving on to the next slide. So we've looked at the few cases already, and so now these are some of the key observations pertaining to these cases. So one is that there's many times a long time between intrusion and detection, right? So you get broken into, and after a long time, you find out. So, and you only find out, a lot of times you only find out when you are told. So how were you told? Maybe the intruder told you, right? They demand a ransom from you. Maybe a third party informed you that your data is available on the black market. And this also could be law enforcement themselves, right? So maybe they're investigating, they found your data, or they found your computers conducting attacks against other organizations. Or sometimes you're told by a third party because they had a breach, and then through their breach, your data is compromised. So that's how you're told, many ways, right? You only find out when you're told. And initially, how did the intruders get a foothold? Phishing seems to be one of the ever popular methods, right? Phishing and other social engineering. And then exploitation of insecure application software, such as the SQL injection attack that we saw a few slides ago, and also the use of exposed security credentials, like in the slide immediately before, right? So credentials were checked into open GitHub repositories. Now, once the intruder get a foothold, once they have gotten a foothold, what did they do? They could exploit unpatched system vulnerabilities, or they could exploit insecure configuration, right? So maybe the systems are patched, but the configuration are not secure. So such as, for example, the open S3 buckets. They could exploit application vulnerabilities, such as by SQL injection attacks. They could also use some under the radar security credentials. Now, what do I mean by under the radar security credentials? So we know that passwords, passphrases, and then for those more technical oriented, SSH private keys, TLS certificate private keys. So these are security credentials. But in this day and age of cloud services, API integration, right? So a lot more things that are known as API access keys, and these are also security credentials. And the more third-party cloud services you use, the more such credentials you have to deal with. And of course, the intruder could also have exploited, and some of these cases, right, they exploited insecure third parties as well. Okay, now moving on to the next slide. So how do we manage the risk of all these key observations? How do we manage the risk? The number one point is to be prepared. Of course, the ideal case is that you never get broken into, your data doesn't get lost. But we don't live in an ideal situation, right? We live in the real world, so it's better to be prepared. It is no good to attempt to develop a security incident response procedure while you're responding to an actual security incident. So you should do it ahead of time. This is not something that's just for IT, nor for the InfoSec people, right? So top management is involved. You need to involve corporate PR to manage the optics, right, public optics. And then if you are dealing with if you're a regulated entity or you're dealing with regulators, then you need to deal with like compliance also. So, and then as I've mentioned, ransomware is now fairly pervasive, right? So touch wood, in the worst case where your data gets locked, you no longer have access to it, then you need to invoke also your disaster recovery playbook to kind of restore your data and bring your services up again. Now, beyond being prepared, the key thing would be to handle the basics, right? So do the cybersecurity 101 training and awareness for everybody. This would cover the standard things like phishing, social engineering. Then for the IT aspects, right? So put together a secure software development lifecycle practices. So things like secure programming guidelines, and then scanning using tools to scan, can be static scanning, dynamic scanning of the software artifacts that are being developed. And then for infrastructure management, you have to put in place secure configuration management. So this involves defining secure build standards, right? And then putting in processes and tools to make sure that your IT assets are configured according to your secure build standards. And of course, all software contains bugs, right? And some of these bugs are security vulnerabilities. So therefore, you also should have a vulnerability patch management process. Now, and in this day of cloud, third-party API integration, you ought to know your data flows. And the overriding principle, the basic principle would be the principle of least privilege. Okay, moving on. Now I'll talk a little bit about new technology, right? So with cloud services, with cloud computing, pretty much you can get anything as a service. So for example, storage, you have AWS S3, Azure, Google, Dropbox, and then you can get virtual IT services such as virtual machines, databases, logging, Docker, Kubernetes, funny words, right? So Lambda, DevOps, and many of these are through automation and API integration. Now, it is important to understand the shared responsibility model between a cloud service provider such as AWS and Azure and you, right? So a cloud service provider, they run data centers, and then the computers inside data centers run the services that you can subscribe to, right? Providing storage, virtual machines, etc. And the cloud service provider's responsibility is to manage this securely and with a sufficient service availability and resilience. Your responsibility as a subscriber to these services, right, is to configure and operate them securely. And unless you're the only person in your team, in your organization doing cloud computing, then more people, then that involves doing identity, authentication, and authorization management. And because many of these are using API integration, so is what is called identity, authentication, authorization management, not only of people, of human users, right? So, but also of software that are doing API integration. Next, I will talk a little bit about DevOps. So DevOps is a thinking, right? So it aims for low friction, highly automated application development, integration, and deployment. Now, if you read the literature on DevOps, many of them will tell you, right? So DevOps is not just about technology, not about tools, but it's also about your processes. In fact, it's a new way of thinking. Now that is true. However, it turns out that the tools actually make a big difference, right? Depending on the tools that you use, the way you would do DevOps is kind of like driven by how the tool operates. And I've looked at quite a number of these DevOps tools, those tools that are known as CI, CD, right? So CI stands for continuous integration. CD stands for continuous deployment. So many of these tools actually, especially if you follow their 5-minute from zero to hero tutorial, right? Where you start from nothing and then 5 minutes later you have a DevOps setup with pipelines defined and jobs defined. Many of these actually operate fully privileged. So the software runs fully privileged on the servers that you set up. And then within the DevOps software, your CI software, your CD software, the jobs that you define, the pipelines, the steps, right, they all operate fully privileged. And because this is meant to be highly automated, again, meaning from stage to stage, there is API integration, right? So questions would be what and where the credentials are. Now, traditionally, the IT environment, you have a perimeter, and then what's inside the perimeter is yours. What's outside is the big bad internet. Now, with a pervasive use of stuff in the cloud, right? Cloud services, then so some of these things happen on site within your environment. Some of this happen somewhere in the cloud. Then the question to think about is also where the perimeter has become. All right, next slide. And this is the final slide here. In summary, right? So to talk about managing cybersecurity risks, number one is to be prepared, especially be prepared for security incident response, be prepared for disaster recovery. Then the next thing is to handle the basics, right? So the one-on-ones for everybody. And then for the IT, the InfoSec, you have to take care of your infrastructure security, application security, data security. And then finally, for new technology, the word here is beware of unknown unknowns, right? So an unknown is something that you do not know that you do not know, which frequently is the case for new technology. Then the important thing is to convert this at least to known unknowns, something that you know you do not know, such that then the next thing you can do is maybe you can find out who are the people who can help you to deal with this now known unknowns. All right, with that, I've come to the end of my segment and I will hand you back to Deepak. Deepak, over to you. Thank you.
Thanks. Thank you. Actually, my headset has lost connection to my PC. So if you, I will just stop the share for a few seconds.
No, it's okay, Deepak, you're back now. I can hear you.
No. I'll just stop the share and then fix this problem.
In the interim, I can already go into the Q&A. We had 2 questions posed on whether the recording is available. This session is indeed recorded. So IBF has the recording of the whole session. So in case you missed something or you want to like rewatch it, that is possible. There's a Zoom link that can be provided. So then those 2 questions are already answered. Please feel free to post more questions. I know this is a lot of content, so that we have a little bit of an interactive discussion in a bit when we're done. I have 1 question already, so please feel free to post additional questions. Thank you.
Okay, I think my technology problem has been resolved. Can you all hear me?
Yes, we can.
Yes.
Okay,
so
excellent.
Then back to you, Deepak. Thank you.
Thank you. Let me just restart the share and then we can proceed. Okay, so let's move on then. I'm going to touch on risks in IT operations. And, you know, you see over here the application stack, right? That is required for any kind of IT operations, from the compute stack at the lowest level to the presentation stack at the top. Risks can exist in any of these. However, that's not the only area of concern for IT operations. There's this whole environment around you, be it, you know, the internal environment, like your heating, ventilation, air conditioning, to external situations like weather, you know, whether you're running a cloud service or not, where you're located. So the environment also plays a very important part when you are doing risk assessment, identifying risks in the IT operation space. And what I'm going to do is to show you examples of you know, risks that materialize in this space. However, when we look at you know, IT operations, we don't look at the technology in isolation. There's always the people aspect and the process aspect that you know, you need to think about when you are doing risk assessment. And I think you'll see an example or 2 over here where there was a people or process failure that actually contributed to risks materializing. Example scenarios of IT operations risks: failure of critical infrastructure application for more than X hours. So this could be a, you know, scenario that requires to be assessed, or there is unavailability or intermittent unavailability or slow performance a platform beyond an X hour period, X, which is X is your tolerance for this kind of risk. I'm going to take you through three IT operations related scenarios here. A couple of them happened quite recently. This was one that actually happened in last month in Texas. There was a storm going on. I think it was due to a hurricane. What happened here was one of Microsoft's data centers in Texas was actually hit by thunder and lightning. Now, because of this, it knocked out a number of services that customers were usually able to access through that data center. So cloud services, Active Directory, which is quite important for authentication, and Office 365. So, when you analyze this event, clearly this was a weather-related event. However, what this also showed is even, you would have thought that with, adequate resiliency and redundancy, if something happened to one data center, services would be accessible from an alternate location. That's what redundancy is all about, isn't it? However, this incident actually showed that there was a single point of failure for some services. So there was a risk that may not have been identified or addressed that resulted in a single point of failure for some of these services. Now, typically when an incident happens, you could associate it back to one or more risks that have materialized, especially if the incident is of a more severe nature. So, if you take this one as an example, there were three risks that actually materialized here. Clearly, there was unavailability of service to customers. There was a risk of inclement weather, which presumably could have been addressed by redundancy, and there was a potential damage due to failure of HVAC. So what actually happened here was when the storm hit the data center lost its cooling services, and cooling services are crucial for a data center because there's a lot of heat generating equipment in the data center, be the servers, the disk farms, network equipment, they all generate lots of heat. And all these equipment are very they are very sensitive to temperature. So they will only operate within a threshold range, and if it gets beyond that, there's a likelihood of failure. So preemptively, what Microsoft did over here was knowing that the cooling services were down and the temperature was rising in the data center, they proactively shut down equipment. That actually was partially what led to the unavailability. What could have been done over here is to ensure adequate resilience and redundancy. I think there would be a need here to assess why there was no resilience that enable users to be able to seamlessly access their services from an alternate location. And also, that's obviously a need to develop and test disaster recovery plans, because if there's no redundancy, if a data center fails, then the failover should happen either seamlessly or with some kind of interaction to an alternate location. So these are the possible things that need to be, the possible risks, that need to be addressed in order for this problem not to occur again. At this juncture, since we're talking about data centers, I just want to touch on a question that was posted here, which says, I assume FI should basically have low appetite to every risk. What kind of scenario can be fallen into acceptable risk? Now, I can use data centers as an example over here. The risk of one data center failing and causing impact is always seen to be high. And that's the reason why, almost every firm, be it a bank or otherwise, financial institution or otherwise, will have multiple data centers, at least two, right? So that if one fails, services can be either seamlessly restored or with manual intervention to an alternate location. So the risk of failure of one data center is seen to be unacceptable, and the mitigation there is to set up a second data center. Now, what's an acceptable risk is the risk of both data centers failing. Now, the likelihood of such a situation is seen to be so low that many organizations take this as an acceptable risk, that there's a very, very low likelihood of both data centers failing, and therefore, because of that, they don't take an action to set up a tertiary data center. So this is an example of an acceptable risk where you have two data centers and the risk of both data centers failing simultaneously is deemed to be acceptable. Now, moving on to the second IT operations related example over here. So this was an update that was happening on a piece of software that RBS in the UK is using for their batch scheduling. Many banks still operate an online environment and a batch environment, and batch processing has become extremely complicated. Typically on any given day or any given night, there'll be jobs in the thousands that need to be run to update balances, to clear out, to move transactions from live databases to historical databases, move data out to archival databases, and so on, right? So there are, lots of these batch jobs that need to be run daily, weekly, monthly, quarterly, and other cycles. So CA7 is designed to automate the batch processing. What happened here in RPS is that there was an upgrade that was being done on the batch processing, the batch scheduling software. CA7 is a product from a third party called Computer Associates. Now this was being done offshore. The upgrade was being done offshore, and it was being done on a weeknight. What happened here was that the upgrade failed, which may happen. And typically the mitigation for a situation where an upgrade fails is to back out the upgrade and revert to the previous version of the software. So that's something that one would plan for, right? So they did initiate a backout. However, as part of the backout, there was a mistake that happened, and this was actually human error that occurred here, where the scheduling queue in the production environment was accidentally deleted during the backout. It took quite a few days to reconstruct that queue because of the complications. And once the queue was reconstructed, obviously, the batch jobs that were backlogged, that didn't happen on that weeknight, needed to be run, plus also additional time to catch up on the batch runs for the intervening days between when this problem occurred and when it was fixed. So I think it was like 3 days worth of jobs that needed to be run. And throughout these 3 days, customers were severely impacted because their balances weren't updated, they weren't able to do transactions, and so on. The analysis here is that this was, this should be classified as a critical upgrade because it's upgrading a fundamental piece of software that is supporting the entire batch operations. It was being done on a weeknight. So that's question number one. Why was it scheduled to happen on a weeknight? And secondly, I mentioned that there was human error over here that actually was because of a knowledge gap that caused the job queue, the scheduling queue, to be deleted. Multiple risks materialized over here. Obviously, unavailability of service to customers. There certainly was a risk and change management governance that allowed a change of this nature to happen on a weekday. And there was also a concern here, a risk of governance of third-party supplies. The work that was being done offshore was being done by a third party that RBS had engaged to do the upgrade for. So in terms of what are the possible responses that should be considered to address a risk like this, is improving change governance. Things like, for example, implementing, defining green zones where changes are only allowed to happen within a green zone. Defining severity or criticality of a change such that a higher risk change is scheduled for a time where there's more than enough time to back out and restore the previous service without causing disruption. With respect to third-party suppliers, this is something that is in the guidelines on outsourcing as well from MAS, is to ensure that there are contractual agreements with the third parties, and also provision in the contracts to perform audits and inspections on third parties where feasible. We know that in a number of cases this is not possible. So, for instance, if you are subscribing to a cloud platform like AWS or Azure, as a subscriber of the services, you would likely not be, AWS would likely not give you the ability to do that audit or inspection. They would provide other means to validate their capabilities and their controls. But for other companies other third parties that you engage, it is a definite possibility. And we have actually undertaken, when I was working in other organizations, we have actually undertaken audit inspections on third parties, even if it meant going to their location in another country, for example. The third one here is also a failed change, software related, software, partially software and partially network related. This again occurred in a Microsoft data center, happened on a number of days. So the first time a software change failed, it was detected on the 28th of September, where authentication requests were unavailable, and Microsoft 365, PowerPoint, Excel, so on, were also not available. The subsequent outage on the 7th of October was due to a network update to a network infrastructure. So again, related to changes. So, if you recall the earlier slide that I'd shown you that breaks down statistics on root cause of incidents, change-related incidents were the highest over there. I think it was, almost like 20+% of the total number of root causes that were identified. This is one that we see quite often. The effects obviously can be quite detrimental. Again, in this particular case, there was unavailability of customers, service to customers. And certainly, another risk that materialized was change management governance. So the responses here are very similar to what I discussed earlier in respect of, what needs to be done to address risks of this nature. I'll move on now and talk about software development related risks. So, in software development, whatever methodology you use, whether it's waterfall, spiral, agile, DevOps, so on and so forth, there's always, these 6 steps that you would do either sequentially in the case of waterfall, and in, other methodologies, you might actually be doing some of these things in parallel, right? And risks can occur in any one of these. So it's important to actually identify risks in each of these stages. Not only that, project management is another key element of software development, and project management can actually also cause risks to materialize, as I'll show you in one example later on. So again, it's not only the technologies, the people and process that you need to pay attention to. And some example scenarios of risks in this space: unauthorized access to software development environment to gain access to production environments. I'll talk a little bit more about this, how and why this can materialize. But certainly this is something that needs to be considered. Project management risks like non-delivery of critical system within X months of its schedule. All right, so let's talk about first a project management risk. This was quite a major one that occurred in 2018 with a bank in the UK called TSB, which was merged with Lloyds in 1995. They decided to go their separate ways in 2016. TSB actually bought a Spanish bank to merge into it and to use its technology when it was migrating away from Lloyds. So time-sensitive project. Lloyds was charging TSB to the tune of £100 million or so a year for the use of its IT platform. So obviously this was a key project to avoid that risk going down the road. So TSB embarked on this migration project, 4 years in the planning, huge effort, 1,000+ professionals, 2,500 person years of effort in total, and lots of suppliers, about 70 suppliers were providing resources for this project. So there was a huge third-party risk that need to be managed as well over here. The project was made more complicated by virtue that this was not a lift and shift. It was not just taking, hardware and applications from the Lloyds data center and moving them into the Spanish bank's data center. It was a complete re-architecting of the platform. So architectural changes, implementation of active data centers for resilience, microservices, new applications, so on. Hugely complex. And this is where you need very good project management to really be able to handle something of this magnitude. Now, as the project progressed, the initial target date for completion here was November 2017. It became very clear a couple of months before that this was not going to be possible because there were huge delays in functional testing that were happening, and a significant number of defects were being generated every week of functional testing. Between 500 and 900 defects were being generated. So that prevented a November live date. The board took a decision, and this was really top-down, without any bottom-up planning, that from a reputation standpoint, they couldn't delay it further beyond Q1 of 2018. So they put the statement out there that this will be done in 2018. There was a lack of transparency as well. They weren't very open about the reasons why. They used alternate reasons to explain the reason for the delay. So they were keeping information internally within the organization, which actually can affect reputation as well if you're not transparent with your customer base. The other thing was that because of the timeline, documentation was generally unavailable for the work that was going on. And that's a huge problem, because when you're undertaking an initiative of this nature, documenting what you're doing, architecture, architectural diagrams, design, testing, so on, they all have to be in place. The other thing that was observed over here was that there was no comprehensive go live criteria. So the triggers, that there are these criteria that must be in place, which have to be met in order to be, in order to move the project on from, its production, its non-production stage to testing stage. So that didn't exist. So the date was moved to April 2018. 2 weeks prior to that live date, there were still around 5,000 plus defects, of which 800 were of the highest criticality. These were essentially showstoppers. In those 2 weeks, about 2,500 defects were promoted to production. So there was a huge amount of code that was being moved into production at the point in time that the code base should have actually been stabilized and frozen. So what happened on 22nd April 2018, which was the weekend, the migration appeared to complete successfully. Within the first hours of reopening of the bank, about 1.3 million customers couldn't access their information, primarily because their data was corrupted. It took 4 weeks for the bank to restore its services. They had to engage third parties like IBM, for example, to provide expertise to normalize the situation. So the impact of this was obviously huge to the organization. 300+ million sterling in payouts for various reasons. Customers lost. Management changes. CEO was moved out as well. So it came down here to project management primarily, right? So the risks that materialize, project status, stakeholder management, testing, defects management. There's very limited, non-functional testing that was conducted, and that was one of the reasons why that contributed to the failure. This active data center that they had implemented, they didn't adequately test capacity, and that was a contributing cause also, besides the data corruption. Again, management of third parties, this was hugely complex, 70+ organizations providing, staff to support this project. So managing those 70 organizations itself would have been a huge challenge. What can be done to prevent, such risk from materializing? Three things here. Firstly, validation. Functional testing, non-functional testing, not negotiable. Whatever methodology you use for your software development, you see validation as your last line of defense before code moves into production. And that's where defects get identified and then get fixed in order for code then to be ready for production. So validation is crucial. It's not only functional, it's non-functional as well. Operational testing, performance testing, capacity testing, so on and so forth. Another possible thing that should be considered is actually verification throughout the project lifecycle. So, validation is something you do almost at the end of the lifecycle, which is testing. Verification is engaging independent software quality assurance function within the organization if you have it. If not, then consider third parties to work proactively with project teams to facilitate the software development process and ensure compliance to process and delivery review of artifacts. So the verification is more ensuring that throughout the life cycle, the process is being complied with. The validation is that the software is in good shape. And I found this other thing to be very effective as well, which is continuously monitoring. So in major projects, you would consider engaging an independent party like internal audit to continuous monitoring of the project, right? Following through and making sure that milestones are being hit, deliverables are coming out and so on. I know that that tends to be an apprehension to engage independent parties, but I've seen this being put to very good use and very good effect in many organizations. So this apprehension about engaging with internal audit is something that needs to go away. And internal audit should really be seen as a partner in making sure that the organization is complying with requirements and its controls are in place. Now the next few are not examples because it's quite difficult really to be able to find live examples of risks that happen in the software development space. However, having said that, there are risks, and what I'm showing you here is based on experience, my experience or experience of friends that I have. So the first one here is sensitive information in code. What we have seen here is that sensitive information like credentials get embedded in source code to make it convenient to access databases and other services or components that the application has to connect to in order to, get its processing done. Clearly, there's an impact over here that if the code itself has got sensitive information and the code is not secured well, and it's put in a library, for instance, that is accessible by multiple parties, there's going to be an exposure, there's going to be a leakage of sensitive information. So clearly, potential responses here are get away from hard coding credentials, move towards, dynamic mechanisms like enterprise password vaults. One thing that could be considered as a defense mechanism is also to scan code and the intranet regularly for sensitive information like credentials. Use of crowdsourced code. Now, many organizations, well, a number of organizations now tend to use alternate ways to, to get code developed very quickly, either reusing code that's available in public domain, or you run a hackathon or some event where you give people an objective to develop a system, a robo advisory or a robocall system, for example, to test out capabilities to basically get innovations done very quickly, right? And there are risks over here if this kind of code is taken and productionized, because could be low quality code, which may have an impact on your production product or service. There may be malicious code which sits in the code that you obtained, and there could be potential IPR implications as well. So clearly the risk that may materialize here, it could end up with services being unavailable, or it could contribute to cyber attacks if there's malicious code sitting in the thing that you productionized. What are your potential possible responses here? Make sure you use only well-used and well-supported code from reliable sources. If you have to use code from third parties, make sure that you're doing code reviews and also doing testing, both functional and non-functional. And last but not least, penetration testing, where you have an application that is web-based to perform penetration testing to validate the robustness of the code. Lax controls in development testing environments. I alluded to this earlier on. Why does this happen? It's a trade-off between control and flexibility. Typically, developers want more flexibility in their environments so that they can get things done quicker without having to go through the process of withdrawing privileged password, privileged credentials in order to have root access to their development environments, for example, to do testing, to do debugging, and so on. So that's one area for lax control. We also see that production data is getting used could get used in software development process. It's convenient because it saves you from creating your own. It also gives you the necessary volume to be able to do performance testing and even capacity testing. The third one here is that you have controls in place, but they're relaxed temporarily to facilitate testing or debugging. Potential implications if something goes wrong over here is data leakage. If the production data that is sitting in the development environment gets accessed and misused. And the other one is, equally concerning, which is that threat actors could actually use the development environment as a means to exploit the production environment, to exploit and gain access to production environment and cause problems then. Right, so leakage of sensitive information and cyber attacks are the two potential risks that are, could materialize. What could you do about these potential risks is make sure that there's adequate use over production data in development environments. Now, there's no doubt that this needs to production data needs to be used in development environments on occasion, for instance, to do debugging. However, there must be adequate controls there to approve the use of the production data. And the other thing is to anonymize sensitive information before it gets used. So once the data has been restored, immediately anonymize and then use the data. Ensure adequate segregation between dev tests and production environments, clearly to avoid the possibility that there's a weakness, between those environments that can actually cause a compromise from development into production. And last but not least, if controls have been relaxed to facilitate testing debugging, there must be similar governance in place to ensure that the controls are reinstated and not left in the relaxed state because they can be exploited. Now, I want to finish up by talking about, a number of risks with these, platforms that now we see in getting to be used more prominently: AI, machine learning, deep learning platforms. I'll talk about two scenarios over here. Now, the first one relates to a Monaco-based hedge fund manager, Tindaris. They have been, or they were rather, using an AI-powered money manager called K1. So K1 is actually an AI platform developed by an Austrian company called 42.cx. Now, this platform seemed to be quite impressive. They did a demo of this platform to a multi-billionaire, Sam Lee, who lives in the UK. The demo was very impressive. It appeared to show positive returns. So Sam Lee decided to invest a notional amount of $2.5 billion US dollars into the hedge fund. There was a commitment that the investment decisions that were being made were solely based on trading signals created by the AI system, which was running on a supercomputer. And this was taking information, real-time news, social media, data from other sources, and then predicting sentiment in financial markets, and therefore coming up with recommendations. Also stop losses were determined by the AI-based system. So these were all the assurances that this product would fulfill. So after investing the 2.5 billion, trading commenced in December 2017. Over a period of 2 months, the hedge fund lost about $22 million from this one investment, including a one-day loss of 20 million on the 14th of February 2018. So total 22 million loss. The customer, Sam Lee, stopped trading immediately after that. Tindaris sued Sam Lee for unpaid fees. Predictably, Sam Lee was unhappy that he lost money and his Valentine's Day was ruined for the year. So he stopped paying fees, and Tindaris sued for 3 million unpaid fees, and Sam Lee countersued for losses. Now, the vendor of the AI platform, 42.cx, has not been named in the suit or the countersuit. However, the implications there are, a reputation damage to the, to the vendor of the platform. So they certainly would have been impacted by what was going on over here. They're still in business, by the way. They offer a free tier if you choose to go to their website, 42.cx, to see what they have. The suit itself didn't progress because the courts threw out the suit by Tindaris for the unpaid fees because they weren't able to come up with a security deposit to cover potential loss of the suit to repay the defendant's costs. So the suit was thrown out in March this year, actually. not much news about the countersuit. It all went very quiet. So, I do not know what the outcome was, whether there was a settlement that occurred, which then, took the countersuit out of the courts. But clearly here, the message is that, when we use platforms with emerging technologies, the ability to audit, to be able to prove why some decisions were made is going to be of crucial importance in order to ensure that the platform is making the right decisions. And secondly is to ensure that adequate testing is being done to give a high confidence that the outcomes that are being predicted are the right outcomes. The second one that I'll touch on is, you might have heard about this service that AWS provides, which is a face recognition service. This service actually is available to anyone who wants to pay for it. So in 2018, the ACLU, the American Civil Liberties Union, they did a test because they actually saw that police authorities in the US were beginning to use this platform to support what the police was doing in the enforcement. Well, it wasn't only the police, it was enforcement authorities that were using this platform. So the ACLU decided to do a test. What they did was they loaded a database of about 25,000 publicly available arrest photos, right? So that was their reference database. What they did was they ran through all the photographs of the 100 members of the Senate and the 435 members of the Congress, so 535 in total, through this recognition product to see what would be the outcome. And there were about 30-something matches detected. So, the platform actually associated 38 of the members of the Senate or the Congress with some of these 25,000 mugshots. And these were clearly false positives because none of the 25,000 were members of the Congress or the Senate. False positive rate of 5%, which could be seen to be quite high, given that in the situation where it's being used, this could be a difference between life and death if someone is arrested for the wrong reasons or someone gets shot for the wrong reasons. What was actually worse was that there was a bias towards persons of color, and this was actually ACLU's bigger concern because all the 20% of the members of the Senate and Congress are people of color, persons of color. 40% of the false positives were against persons of color. So that was actually even more alarming. Now, recognizing this, actually it took a couple of years for Amazon to then stop the enforcement authorities from using this platform. So I think it was in June or July this year that they have stopped enforcement authorities from using this platform for the next 12 months, presumably because they want to, improve the platform. So the point here is that, again, when these platforms are being used, there's a need to ensure, high degree of accuracy. Otherwise, it can have detrimental implications to, and detrimental outcomes. All right. Now, to wrap up, effective risk management. We talked about this in the beginning. Just want to re-emphasize, you are part of an ecosystem. All of you on this call are part of an ecosystem that, that is involved in protecting and ensuring the safety and security of the industry, right? Whether you're a fintech or a bank or a financial institution, asset management house, every one of you. It ensures that you're able to comply with your customers' requirements your customers' compliance requirements. They have requirements from regulators. They have their own requirements they impose upon you. You have to comply with them. Those are compliance related. As I mentioned, you can use risk management to your advantage because it gives you a step up when you deal with prospective customers, because you're confident that that your risks are well managed. The discipline can be readily adopted. It requires the right level of commitment from the very top and the right sponsorship. And last but not least, risk management is everyone's responsibility. It's not only the board or the CEO or the executive management. Everyone in the organization has to play a role in risk management. So with that, I thank you very much for your attention, and I will pass you back to Stefan.
Thank you, Deepak. So we're coming towards the end of the session, and I would like to encourage you to basically go and post a couple of more questions on the Q&A, so that we have maybe 10-15 minutes to take your questions and answer them. What I want to show you on the slide is the resources available. We have put in some QR codes for you, so you can just take your hand device and then scan the QR code to have either access to what we can offer in the risk management practice. We have a brochure that you can download and have a look at. And the second part goes back to what we discussed earlier with Subnandu, which was the compliance readiness program. We are one of the partners that are on the Singapore FinTech Association webpage. And again, that is something that is available. So if you want to reach out for a chat, if you want to have an additional piece of information, or you want to engage us for anything from doing an assessment, doing remediation, giving recommendations, these are resources that are available to you. We have also a quick survey. So this is the first time that we did this with IBF, and we thought it's helpful to basically bring this together down to a 2-hour format, to give again, the key trends, the key pillars that are necessary that managers need to know when they're in the fintech space. There's a QR code for a quick survey. So we would be most grateful if you could have a look and give us some feedback, so that we can see what we can offer in the future and how we can make sure that this time space for a masterclass is used as good as possible. I have no questions for the moment, so let me go to the next slide, which shows all the partners that we have that are our experts. We have about 60 consultants, but on the next slide we have the 4 key contacts you can reach out to. We have the mobile numbers, the email addresses. So if you have a question, if you want an additional chat, Stephen already offered lunch or a coffee. We can certainly do the same. And again, the QR codes here again, if you can take your time and fill in the survey, most appreciated. I'm just looking at the chat and I don't have any questions in the chat. The question came up whether there will be a printed version, and yes, there will be a PDF version in IBF. We'll send that out with your certificates of attendance. So that's a package you will get, so you can have a look. We earlier on shared the webpage for the Singapore FinTech Association, so you can have a look at the program. And again, we're happy to help you with walking through the program and what is there. And of course, www.singaporeconsultancy.com, where you can also download and look at information as required.
Thank you, Stefan. Can I say a few words quickly?
Of course.
Thank you. So thank you for staying on. I know we overrun a little bit, but I'm delighted to hear that there's still 146 participants so far. Thank you. And like I said earlier, my number is on the website. If you click on the WhatsApp icon, or if you leave a note on the website, it will go straight to my inbox. I look forward to meeting you over coffee or lunch, and it will be on me.
Okay, so Gresson asked the question on the recorded session. Yes, this is recorded, and IBF has a Zoom link that they can make available if you wanna replay. Other than that, let me one more time summarize. Subnandu said, look, if you want to raise capital, it is important that you can demonstrate that you have a good a command on your risk management, that you have a discipline there. There are many aspects for running an entity in a sustainable fashion, and it's not only when you are subject to a licensed PSA or capital market services, or you deal with regulated entities. The program that's out there and the help that's out there is basically for everyone. And I hope that we were able to give you an overview of what matters and what's important today. Florence, I don't have any other questions. If you want, we can wrap up the session.
Okay, thank you so much. Okay, so thanks once again to our partners and our speakers from the Singapore Consultancy. We will be sending across slides and the video link to this recorded session. So if you have more questions, feel free to reach out to them. The deck will bear their email, so feel free to reach out to them. And if you have any questions for the IBF, please scan any of these QR codes or just write to us. And you can find out more about the training grants that are available to you on our website. So with that, I thank you once again for joining us, and I wish you a very good afternoon.